it happened. I thought it might happen this year. I wasn't sure exactly when it would, but it happened this week, which means a recession is probably ahead. You might have heard of this thing called the inverted yield curve, which sounds really scary and complicated, but it's super simple. Picture the inverted yield curve as Gollum right here. He knows all the best places in the world, and he's pretty reliable, and he'll take you to them, but the moment that you turn around, even for just a second, he'll bite your finger off. That didn't make any sense. I just wanted to show you a magic trick. Actually, this analogy makes way more sense. Check this out. Imagine that this is my hand right here, because it is, and look at the pinky right here. 3, 2, weird. The old detachable finger trick. Ew. Now in the past, the inverted yield curve has accurately predicted 5 of the last 6 recessions dating back to 1978. And whenever we got this yield to invert, it takes on average between 6 to 18 months for us to go into a recession, which means we could be in one as early as October this year or as late as October next year. And that's because on Monday of this week, the spread between the 5 and 30-year Treasury bond interest rates flipped. And the last time that happened was in 2006, which was kind of a foreshadowing. Then on Tuesday of this week, the spread between the 2 most important bond yields have also flipped, the 2 and the 10. And the last time that happened was in 2019. Now, if none of those words meant anything to you and it all sounded like gibberish, in today's video, I want to help break everything down as simple as I can, because if you're someone especially investing in the markets with stocks and real estate and crypto, it seems like a very scary time to be invested. And then later in the video, I want to help put everything in context and relate it back to how this affects us in everyday life. Part of this video was sponsored by Titan, but more about them later. I'm excited. Let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the magic. And I know what you're thinking. Andre, those are some sick ring tricks. Do you have more? Well, yes, I do. Besides the original one where I take the ring and throw it back on my finger instantly, there's plenty more where that came from. Like this one where you can place it on the index, back to the middle, back to the index, back to the middle. It's kind of weird. Also this one, which passes solid through solid in 3, 2, ha! I know what you're thinking. This has nothing to do with finance videos. But magic has everything to do with finance videos because no one has any idea how magic tricks work and no one has any idea how the economy works. It's kind of like one giant sleight of hand trick. Because I was thinking the other day, have you ever noticed that when oil futures go up in value, gas prices at the pump go up almost immediately? But when they go down, gas prices at the pump take days, if not weeks, to go down. Also, whenever the Federal Reserve increases the federal fund rate, our interest rate on loans and mortgages and credit cards goes up almost immediately. But our savings accounts interest rates, those take months to go up before we see any benefit. Think about it. The average yield on a savings account is 0.06%. That's how much the bank is paying us, which means for every $1,000 we have on deposit with them, they're paying us 60 cents per year. Meanwhile, inflation is stealing $70 per year. Now, low interest rates on savings accounts made sense a few years ago when the federal fund rate was 0. But now that rates are going up, so should our savings accounts, but they're not. And here's exactly why. It's because of bonds. James bonds. Banks always follow bond yields. The 10-year Treasury bond yield, for example, right now is somewhere around 2.3%, which means on the high end, we should be earning somewhere around $23 a year for every $1,000 we deposit, not 60 cents. To be fair to banks, it might be more accurate to look at the 1-year Treasury bond yield because it's a lot safer for banks to assume that we'll be keeping our money with them for a year, not 10. But still, even the yield on the 1-year Treasury bond is 1.6%, which is so much more than 0.06%. Now, here's the part of the magic trick that's really gonna blow your mind. Right now, banks are able to take the money that we deposit with them and invest it into the safest investment that anyone could ever make, which are Treasury bonds. If they buy the 1-year Treasury bond, hold on to our money for a year, they will make all of that money back plus interest. And as of right now, the math works out to be an annual return of 25 times on our deposits, which is just insane. And the reason they can do this is because of QE, quantitative easing, infinite money glitch, money printer go, because they don't need our money. Check this out. As of 2020, they had roughly $13.2 trillion on deposit. But ever since we flooded the system with more money, they are now richer than they've ever been before because they now have over $18 trillion on deposit. And they don't need to incentivize people by giving them a higher interest rate on their accounts because, again, they've never been richer. But it goes even deeper on why this is happening. But first, a quick word from today's sponsor, Titan. Titan is an investment platform for everyday investors that want their money actively managed by a team of experts. Their goal is to grow our investments by 15% per year, which would imply doubling our money roughly every 5 years or so. One of the things I really like about them is that you get to learn how your money is managed through videos and written updates directly through their app, so you get to understand their investment thesis. And here's exactly how it works. You get the app, you put in your profile details, and it gives you a customized portfolio based on your risk tolerance. Since I'm a client of Titan's and this is a sponsored video, I put in my own money just to see if they can beat the stock market for me, and I'll let you know the results at the end of the experiment. But for now, based on my risk tolerance, 60% of my money was sorted into Flagship, which is made up of 15 to 25 high-quality big-name companies from the stock market, another 17.5% into Opportunities, which is made up of small caps or small companies, another 17.5% into Offshore, which is in emerging markets, and another 5% in crypto, which is made up of 5 to 10 hand-picked cryptos. All it takes is $100 to get started. And if you go to titan.com/Andrei, you'll get your first 3 months of investment management for 0 fees. That's titan.com/Andrei, 0 fees. Thank you, Titan, for sponsoring this part of the video. Now let's get back to it. Okay, so hopefully we've established that banks have a ton of our money, but they're not really incentivized to pay us more anytime soon. And that's partially because the federal fund rate has been artificially kept close to 0 since 2008. Now, they did try to increase the rates sometime in 2016, and they did, up until they dropped them back down to 0, and they had to use a phoenix down in the economy to make sure we don't game over. That's why most of us probably don't even remember what it was like to make money in our savings accounts, which is also why I keep like 19 cents in my savings account, because I realized that by keeping my money there, my savings rate is actually negative. And that's because if we take the average savings account interest rate of 0.06% and subtract inflation from it of, let's say, 7%, we get a real rate of return of negative 6.94%. Now, if you're a bank and you realize that interest rates are close to 0, are you really all that incentivized to lend your money at almost nothing and take all that risk? Probably not, when you realize that you can just take customer deposits and buy something safe like a treasury bond and make a guaranteed rate of return of 25 times on your money. That's also why we had a huge run-up of assets in 2020 and 2021 as people realized that they needed to invest and they couldn't keep that money in their savings accounts anymore. And that's also why we've seen a record-breaking risk-taking in the markets as well. Check out this data from Q2 of 2021. We hit an all-time high of margin loans inside of brokerage accounts, which can be extremely profitable, but also very risky. That's partially why home values went up like crazy as people scrambled to park their money somewhere that was safe other than their savings accounts. It's also why I bought a house recently because, sure, it's definitely risky at this point in time, but would I rather take my chances in the market where I can at least protect myself, or should I keep my money in my savings account where I'm guaranteed a 100% chance to lose my money thanks to inflation? And the more people realize the truth of this crazy magic trick, the higher asset prices will go, which is also why some economists are trying to warn people that there could be a recession ahead because of all this excess risk-taking. And maybe that's true, but if that's the case, we have to go back and look at bonds. From the spring of 1996 to March 2020, bonds produced an average return of 8.2% versus the S&P 500, the stock market's 8%. How? That's not supposed to happen. Think about that. Bonds beat stocks from 1996 to 2020, and they did that with a third less volatility than stocks. So while everyone was panicking about the stock market, the bond investors were just as chill as cucumbers. Here's how that happens. When the stock market becomes crazy and people become fearful, they start buying bonds. And there's 3 things you need to know about bonds. Number 1, when you buy bonds and you keep them until the maturity, you will get all of your money back plus interest. You will never lose money on a bond as long as you buy the right ones, like bonds from the government, and you just hang on to them until the maturity date. Number 2, you can sell your bonds before the maturity date, but chances are they'll be worth less in the open market to someone else, but it all depends on what the federal fund interest rates are doing. For example, If you bought a bond for $100 at 2%, you know that at the end of the year, let's say the expiration date is just 1 year, at the end of that year, you get your $100 back plus $2 in interest. That's how much money you made. But now let's assume that during the time that you were holding, the Federal Reserve issued more bonds because they started to increase their rates to 3%. Well, now there's bonds in the bond market yielding 3%. So why would anyone want to buy your 2% bond if they know they could buy a fresh one for 3%? They're going to make $3 on their $100. That's why your bond, when you try to go to sell it, becomes worth less if you don't hold on to it until the maturity date. A perfect analogy is Tom Brady's last touchdown football. If you remember, on March 12th this month, someone bought his last touchdown football for $518,000, which is an insane amount of money because it was supposed to be his last one. But then he just rug pulled the buyer and he was like, just kidding, I'm back. It's not gonna be my last one. So obviously the value of that football is gonna go down if the buyer tries to sell it in the open market because it's no longer his last football. And that's exactly how it works with bonds. If you hang on to them though, you get all your money back. And the third thing to know about bonds is that their prices always move in the opposite direction to interest rates. If interest rates fall, bond prices go up. And if interest rates go up, then bond prices fall. And hopefully you understood exactly how this happens from the football example. But if you're someone who wants to just buy the bond and hold it until maturity, it doesn't matter because you get your money back plus interest anyway. But if you want to speculate and sell your bonds ahead of the maturity date to someone else, that's when it starts to matter. See, isn't this fun? I love learning about bonds on a Friday. Nothing better to do with my time. But that's why bonds play such an important role in the market psychology of everything, and here's exactly why they matter so much to this recession warning. There are 2, 3, 5, 7, 10, 20, and 30-year treasury bonds, but in a nutshell, the 30-year treasury bond is gonna pay you a higher interest rate than the 2-year one because technically by buying the 30-year one, you're locking your money up for a lot longer, which is a lot riskier, therefore you get paid more. Now, the two most important bond yields that economists always like to compare against each other are the 2 and the 10. And on Tuesday, they flipped, meaning that the 2-year treasury bond yield paid more than the 10. And whenever that happens, that's a sign that the economy is going to slow down, which points to a recession. In the rare chance this happens like it did this week, people sometimes panic because since 1978, this yield curve has accurately predicted 6 of the last 7 recessions, which don't always happen right away. They happen anywhere between 6 to 18 months after the yield curve inverts, which means that either October this year or October next year is when we're technically due for one. And that brings us back to the original question, is it maybe worth it to convert some of our assets into bonds and wait until after the recession? And the answer is, it depends, because since 1978, the inverted yield curve has produced a positive stock market in 5 of those last 7 times, which means technically the stock market doesn't have to go down if you're investing in the long term. I think it's easy for me to say because I'm on the younger side to stay invested in the markets for as long as possible. I know most people watching my videos are also on the younger side, which means hopefully they'll stick around for the long term to see their investments go back up. But that's not always true for everyone, especially for people that are older. And if my parents asked me this question, I don't know if the answer is as straightforward. It might be worth it to buy some bonds, but chances are you already could be without knowing it because of target date funds, which you could own through your 401k account with your employer. It might be worth it to check because those target date funds start off while you're younger, heavily skewed towards stocks, which are riskier, which makes sense when you're younger. But as you get older, those stocks get sold off automatically and get converted into bonds to protect the wealth that you've built. Beyond knowing every person's financial situation uniquely, there's no one-size-fits-all answer, but if I was somebody who was older and I was trying to protect some wealth, I would probably wait until May 3rd and May 4th to see where the Fed was going to take the rates. Maybe they'll increase by 0.5%, maybe more, maybe less, but at that point, they should be selling off their bonds. And when they do, the price of those bonds will fall and their rates will start to go up, which means it might be worth it to wait for as long as possible to buy some cheaper bonds and make more passive income through those higher rates. But I obviously don't have a crystal ball, so I can't answer that question for everyone. As always, don't forget to have a wonderful rest of your day. Smash the like button, subscribe if you haven't already for all those awesome magic tricks if you want to see more. And in the meantime, I will see you back here on Monday and Friday, sometimes a Wednesday. Don't forget to check out all the free stuff, link down below. Love you, I'll see you soon, bye-bye.